$128 billion vanished from the crypto market in a single day, not because of a hack, not because of a Fed decision, because one airstrike changed the Middle East forever. If you are holding Bitcoin right now and you do not understand what just happened, this is the video you cannot afford to skip. Welcome to Capital Anchor. I break down what is actually happening in markets while mainstream media keeps you distracted. If you are new here, subscribe right now because what I am about to show you completely changes how you think about Bitcoin and war. Saturday, February 28, 2026, the world woke up to something nobody predicted. U.S. and Israeli forces launched coordinated airstrikes deep into Iran. President Donald Trump confirmed the operation was active, calling it major combat operations targeting Iran's missile, naval, and nuclear infrastructure. Then the bombshell dropped: Iranian Supreme Leader Ayatollah Ali Khamenei, the man who held absolute power over Iran's military, foreign policy, and nuclear ambitions for decades, was dead. Bitcoin was trading around $66,000 when the first reports broke. Within minutes, it plunged to $62,938. That is a 4.2% drop in under 60 minutes. Ethereum fell 5% to $1,783. XRP followed. According to CoinGlass data, $128 billion in total crypto market cap was erased almost instantly. Then something strange happened. By Sunday morning, March 1, 2026, Bitcoin had climbed back to $68,196. Ethereum stabilized above $2,000. The crypto market had recovered $32 billion of those losses before traditional stock markets even opened for the week. Most people saw this and thought it was random noise. It was not random. It was a playbook, and understanding that playbook is worth real money right now. Think of Bitcoin like a smoke detector in your house. The moment a fire starts, it screams, everyone panics, people run for the exits. But sometimes the alarm goes off and there is no actual fire, just smoke from burnt toast. The detector cannot tell the difference. Neither can automated trading algorithms. When geopolitical headlines hit, algo trading systems do not read context. They read keywords: war, strike, Iran, explosions, sell, immediately. No questions asked. That is exactly what happened Saturday. The algos reacted, leveraged positions got liquidated, panic sellers followed, and Bitcoin fell off a cliff, not because the fundamentals changed, but because machines made decisions in milliseconds that human traders could not override fast enough. This is the hidden mechanism most retail investors never understand. The crash was not a verdict on Bitcoin's value. It was a liquidity drain caused by automated fear. Reason number 1. Leveraged positions were the first to go. The crypto market operates 24 hours a day, 7 days a week. When geopolitical shocks hit on a weekend, traditional markets are closed. Crypto becomes the only pressure release valve available to global traders. Leveraged long positions bets that Bitcoin would keep rising got margin called instantly as the price dropped. Those forced liquidations accelerated the sell-off, turning a 1% dip into a 4.2% crash in under an hour. This is not new behavior. This is the machine doing exactly what it is programmed to do. Reason number 2. Iran sits at the center of 1/3 of global crude exports. According to CoinDesk analysis from March 1, 2026, if markets interpret Khamenei's death as raising the probability of supply route disruption, energy prices spike. That pressures inflation expectations, that tightens financial conditions globally, and that typically weighs on risk assets including crypto. In the current 2026 market environment, Bitcoin is trading much more like a high beta tech stock than like gold. When macro fear spikes, Bitcoin gets sold alongside Nasdaq. That is the brutal truth most Bitcoin maximalists refuse to accept right now. Reason number 3. The weekend liquidity problem amplified everything. Polymarket, the prediction market platform, spun up over a dozen Iran-related contracts within hours of the strikes. The Khamenei removal contract alone pulled in $45 million in trading volume. Traders were actively pricing in probabilities of ceasefire dates, regime change, and U.S. ground operations, all while Bitcoin was swinging $5,000 in a matter of hours on thin Sunday volume. That $64,000 to $68,000 swing, that $80 billion market cap move, it happened on some of the thinnest trading conditions of the entire year. Now here is the part that should make you sit up straight. while retail investors were panic selling Bitcoin at $63,000 on Saturday. What were the big players doing? They were watching, and then they were buying. According to 10x research head Marcus Thielen, traders were not just reacting to Iran. They were already positioning themselves for the upcoming Federal Reserve meeting. The geopolitical shock was a distraction. Smart money saw the dip and treated it as an entry point, not an exit. Demand for upside Bitcoin call options bets that Bitcoin will go higher visibly picked up in the days before the Iran strikes even began. Institutional traders were not surprised by the volatility. They were prepared for it. While retail investors were dumping Bitcoin in fear, institutional players were loading up on cheap calls. While you were reading panic headlines about war, they were executing positions at prices that may not be available again for weeks. Gold told the real story. On hyperliquid, gold perpetual futures spiked over 5% to $5,464 per ounce. Silver surged more than 8% to $97.5 per ounce. Tokenized gold hit $5,494 as the strikes continued. Traditional safe haven assets were flying while Bitcoin was being treated as a risk asset by the very same traders who call it digital gold. That contradiction is the story nobody in mainstream media is talking about today. But here is what most people completely miss. The real question is not what Bitcoin did over the weekend. It is what Bitcoin does when Wall Street opens Monday morning and the full weight of institutional money starts making decisions. Look at October 2023. Hamas attacked Israel. Bitcoin was trading around $27,000. The market panicked for exactly 72 hours. Then Bitcoin reversed and went on to hit $73,000 within 6 months. Look at February 2022. Russia invaded Ukraine on a Thursday morning. Bitcoin dropped 8% in 24 hours. Then it recovered fully within 10 days. The pattern is not a coincidence. It is a roadmap. Every time a major geopolitical shock hits on a weekend, Bitcoin absorbs the panic. Then traditional markets open. Risk spreads out across equities, oil, and bonds. Bitcoin stabilizes. Then Bitcoin climbs. This is the third time in 4 years this exact sequence has played out, and most retail investors have missed the recovery every single time because they sold during the panic. Now look at what has not changed since Friday. Structural factor number 1. Bitcoin ETF infrastructure is real and it is not going away. Analysts at Bitwise and Vonek confirm that spot Bitcoin ETFs are now holding over 1.5 million BTC. That is institutional money with a long time horizon. Those funds do not panic sell over a weekend headline. They sit, they hold, and that creates a structural floor that simply did not exist in 2022 or 2023. Structural factor number 2. Bitcoin hit $125,000 in late 2025. That means the current price of $67,000 is a 46% correction from the all-time high. That is exactly in line with historical bull market corrections. In 2021, Bitcoin corrected 53% from its April peak before recovering and hitting a new high. In 2017, it corrected 40% mid-bull run before exploding another 400%. We are inside a correction range that is completely normal for a bull cycle. Structural factor number 3. The Fed is not hiking. March 6, 2026, just 5 days from now, the U.S. February jobs report drops. Markets are pricing into rate cuts before the end of Q2 2026. Cheaper money is historically rocket fuel for Bitcoin. If the jobs report shows labor market softness, the rate cut timeline accelerates and Bitcoin benefits directly. Structural factor number 4. The pro-crypto regulatory environment under Trump is intact. Bipartisan stablecoin legislation is advancing. A U.S. strategic Bitcoin reserve remains a live policy conversation in Washington. These are not rumors. These are structural tailwinds that the geopolitical noise of this weekend did not erase. Now I am going on the record. Screenshot this. Bitcoin hits $78,000 by April 2026. Here is the logic. The $60,000 support level has held through every test since November 2025. The Iran shock has been absorbed. The leadership vacuum in Tehran actually reduces the probability of coordinated retaliation. No one is in charge to give the order. The March 6 jobs report will likely accelerate Fed rate cut expectations. ETF institutional buyers will return on Monday. And the historical pattern of geopolitical shock recoveries in Bitcoin is consistent and documented across multiple cycles. $78,000 by April 30, 2026. That is the call. Now let us talk about scenarios. Scenario 1, probability 55%. Iran's power vacuum leads to de-escalation. No Strait of Hormuz closure. Traditional markets open Monday with moderate selling. Bitcoin holds $65,000, grinds higher through March, and tests $75,000 to $78,000 by end of April. The recovery follows the October 2023 playbook almost exactly. Scenario 2, probability 30%. Iran's Revolutionary Guards launch major retaliatory strikes on U.S. bases or on Israel's critical infrastructure. Oil spikes toward $120 per barrel, inflation expectations jump, the Fed pauses rate cut plans, Bitcoin retests $60,000 support. If $60,000 holds, the long-term bull case is still intact. If $60,000 breaks, the next support sits at $52,000. Scenario 3, probability 15%. A full regional war erupts. Multiple countries are drawn in. The Strait of Hormuz is disrupted. Global recession fears spike. Bitcoin falls to $45,000 to $50,000 range. This is the tail risk. It is real, but it is a minority probability based on current military and diplomatic signals. Now here is the practical breakdown by viewer type. If you are holding Bitcoin and you did not sell during the weekend panic, you made the right call. The historical data is on your side. Watch the $65,000 level. That is your short-term support. If it holds through the Monday open, the recovery thesis is intact. If you are using leverage or actively trading, reduce your position size right now. Volatility is still elevated. The CBOE Volatility Index jumped 6.6% to 19.86 on March 1, 2026. Thin markets plus high VIX plus geopolitical uncertainty is a dangerous combination for leveraged positions. Protect your capital. First, if you are sitting on cash and watching from the sidelines, this is the moment you study, not the moment you act in panic. The next 48 to 72 hours will tell you everything. Watch how Bitcoin responds to the Monday equity open. If Bitcoin holds above $65,000 while stocks gap down, that is a significant signal of genuine structural demand. If you bought at the top near $125,000 and you are underwater, understand that a 46% drawdown from peak is within the normal range of Bitcoin's bull market cycles. The question is not where you bought. The question is whether the structural thesis, institutional adoption, ETF demand, regulatory clarity, having supply dynamics is still intact. The data says it is. Here is what to watch this week. Watch the DXY, the US dollar index. It is currently at 97.57 and falling. A weaker dollar is historically bullish for Bitcoin. If DXY continues to drop below 97, that is a green flag. Watch the US 10-year Treasury yield. It is currently at 3.96% and falling. Bond markets are pricing in risk-off sentiment. If yields continue lower, it signals economic fear, and paradoxically, that eventually becomes a tailwind for Bitcoin as rate cut expectations accelerate. Watch Brent crude oil, currently at $72.48, and rising 2.45% on March 1st. If oil crosses $80, inflation fears return. That delays rate cuts. That is bad for Bitcoin in the short term. Watch COMEX gold, currently at $5,267 per ounce. Gold is near all-time highs. Bitcoin is 50% below its all-time high. That divergence either closes with Bitcoin catching up to gold, or it signals that Bitcoin has genuinely lost its safe haven narrative. Which direction it closes tells you everything. Now, 3 types of people are watching this video right now. The first type is panicking. They sold at $63,000 on Saturday and are now watching Bitcoin recover to $67,000 and feeling sick. They make decisions based on emotion and they will keep getting hurt. The second type is frozen. They know they should understand this situation. They have watched the price move $5,000 in 48 hours, but they cannot decide what to do, so they do nothing. Information paralysis is costing them. The third type is learning. They are watching this video, they are studying the pattern, they understand the geopolitical liquidity tax, They know the $60,000 support level. They are watching the Monday open with a plan, not with fear. Every market crisis transfers wealth from the first two types to the third. The people who studied the October 2023 pattern bought at $27,000 and sold at $73,000. The people who panicked sold at $27,000 and bought back at $50,000, same event, completely different outcomes. Bitcoin went from $63,000 to $68,000 in 18 hours. Not because the war ended, not because the crisis passed, because informed money recognized the pattern and acted while everyone else was frozen. One man's death shocked the world, but the market's reaction was not about one man. It was about structure, liquidity, and the timeless transfer of wealth from the unprepared to the prepared. That is what is actually happening right now. If this video gave you a clearer picture of what the markets are really doing, hit like, subscribe, and send this video to one person who was panic watching their Bitcoin balance this weekend. Drop one word in the comments right now, prepared or panicked. Tell me which type you are. I read every single one. This video is for educational purposes only and does not constitute financial advice.